it is my pleasure to turn today's call over to Vinay Nadkarni, Head of Global Business Development.
Thanks, everyone. We're taping this right at the market close on St. Patrick's Day. So I guess given there weren't any parades today, we at least got to see some green on our screens. With the S&P look like it's closing above 2,500 today. So with large caps again well outperforming small caps on the day, which has been a theme I think for the year. So I'm here virtually with Margaret Vetrana, who is co-portfolio manager of the ClearBridge Large Cap Growth Strategy. We thought with the market volatility, it was important to speak directly to clients. So Margaret, thanks for taking the time to do this call today. Sure. So my first question to you is around temperament. We have a lot of clients who have entrusted you and Peter to be Peter Bourbeau to be stewards for their large cap growth assets. And beyond intellect and process, what has always amazed me about you personally is your temperament and ability to stay calm through a host of scenarios, which we also saw firsthand when you were on CNBC on Thursday. So when the market is showing this type of volatility, how are you and Peter kind of staying calm and focused on the process? And in a world of data deluge, what are the key signals or data points that you're focused on at either the macro level right now or at the company level?
Thanks, Vinay, and thanks everyone for tuning in. Look, I think as the market moved higher in 2019 and early 2020, some of you may heard us talk about how our whiteboard was more well populated than it had been in some time, and that's because we kept thinking, okay, let's keep doing what we've been doing. Let's keep populating the whiteboard with names that we want to own at a certain price. And the silver lining right here, right now, is that as the volatility has picked up, we already had a shopping list of quality companies ready. I think the fact that we were somewhat ready for this drawdown, although it certainly has been different and more complex than anything we've seen before, I think that being ready for it helped us stay focused on the changes that we wanted to make in the portfolio and be quite active over the last couple of weeks. If you recall, we started talking about our recession analysis in mid-2018, and that analysis was helpful in getting us focused on where there could be risk in the portfolio. That helped us make some moves like trimming our energy exposure. I believe that was the first quarter of last year, but in 2019. And in 2019, as we were doing fundamental analysis on all of the companies as we have been doing for the last several years, we started trying to sensitize any investment for what could happen in a recession, just so we could understand where there might be more risk and where there might be less risk. Two easy examples from that analysis were Booking, which we started a position last year. In the recession analysis, I think one of the things that came out was that Booking has 2/3 of their costs are variable costs. And I think that while obviously travel is being hit hard right now, that's one that I think they're going to be able to manage through the downturn quite well, given that they have a very variable cost structure. Another example is Aptiv, which makes electrical systems for vehicles and connectivity in cars. That one, as we did that same analysis, what we realized was that the decrementals were going to be quite severe in a downturn, and we held off starting a position because we certainly didn't think any recession was priced into the stock last year. So it's only been since a recession has started to be discounted into the stock market and into this name in the last several weeks that we think it's more interesting as a long-term secular share gainer.
Right, and Booking you bought last July, and then Aptiv, right, you've kind of bought during this kind of market drawdown.
Yep, that's correct.
Yeah. So, I mean, most of our clients know about your kind of portfolio construction parameters and the buckets and a goal of having exposure across stable, select, and opportunistic stocks. You kind of talked about it a little bit, but, obviously a lot of clients ask us, we've always said that that's much more a bottom-up exercise than a top-down exercise. But how are you thinking about portfolio construction right now, and how would you talk to clients about, in a time when everything's kind of getting sold down, does each part of that portfolio play its proper role kind of during this type of washout?
Well, look, I think the portfolio construction framework is meant to make sure that we have a balanced portfolio. So I would say first and foremost, we're still using that construct, the buckets construct, to help us make sure that we keep diversification. You did hear us talking late 2008, 2019, and in the last couple of weeks that we had trimmed a little bit out of our select bucket as we were pivoting more defensive. And you saw us talk about how in the early parts of this downturn that we're holding a little bit more cash. So I think that's kind of how we're using it right now. But I don't think, even though obviously the market has had a severe drawdown, we don't want to sell everything out of our select bucket because, of course, the way we think about the long-term investing premise is that we want to make sure that we have some exposure to that on the other side. I keep saying to the analysts, on the other side, we want to make sure that our companies that we're investing in and that we're holding on to can survive the downturn and have very healthy balance sheets, but we want to make sure that we can participate in some upside on the other side of whatever we're going through right now. And so I think we want to keep some of that select exposure in the portfolio as well. So the buckets approach is really just a way of saying we want to make sure that we remain diversified in the portfolio.
You referred to the whiteboard, which I've seen in your office, which I may not see for a couple months here, but I've seen in your office before. But we've also talked about your one-pagers and kind of what the name in the portfolio, thinking about. And we talked about this early on that your goal is we're inevitably going to get something wrong about every stock, but the whole idea is to make money even if we get something wrong if we've got risk reward in our favor. But as you said, price is down on everything now, right? And you're probably nothing in your one-pagers could account for this. So when everything's down so much, it's really more like a prioritization thing. So how do you decide what to focus on over others during these times? And given how much sensitivity analysis you, Peter, and Amanda do with the analysts, what are the type of haircuts you're putting on 2020 or anything, after that, frankly, in your sensitivity work?
Yeah, the core of what we are doing now is the same as what we've always done, which is try to stay focused on good businesses that we think we can perform well through a business cycle and over a long term. I think the new wrinkle in terms of our process and what we're doing is, to your point, we're stress testing everything to make sure that our companies are going to be fine in case the looming recession is longer than we think. I think our strategy team is now talking about a 75% chance of a recession. That much seems clear. What's not clear is how deep and how long it's going to last, because on the other side we obviously have a lot of stimulus that's going to be working its way into the economy. So we have done more liquidity analysis and stress tested all of our portfolio holdings. In fact, and it really started because we were thinking about some good companies that we own, like Disney, and I was thinking, no, Disney's balance sheet is fine, but I mean, let's assume that 50% of their EBIT goes away, because obviously they have exposure in film, they have exposure in advertising, they have exposure in theme parks. So there could be some very severe near-term hits to a lot of companies. And so we went through the whole portfolio and assumed a 50% hit to EBIT or EBITDA to see, in that case, who might have a relatively levered balance sheet or have a little bit more difficulty covering interest expense. And from there, we came up with some companies that we wanted to dig further on. Some of them I'm not worried at all about, because something like Equinix, which in that case would be quite levered, but they have a very stable cash flow business, and a lot of their CapEx is growth CapEx instead of maintenance CapEx. So, but those are good conversations to revet with our analyst team and just make sure we really understand of anybody that could possibly have some liquidity issues. We want to make sure we understand, what the revenue mix is, what the customer mix is, what percentage of their costs are variable versus fixed, what their lines of credit are. All of those kinds of questions are things that we're engaging with the analysts right now on.
We've messaged to clients consistently that the turnover for the portfolio over a longer period of time is relatively low, 15 to 25%, but it should pick up and be higher in these periods of volatility. And just seeing the trades that come across almost daily, that the strategy has done that in spades these last 3 weeks. So you talked about active a little bit earlier, but maybe you can talk about maybe some lessons learned, as you said, from the recent analysis, your down capture, and maybe talk about what you were trying to achieve with kind of the new purchases, some of the sells, and kind of the ads and trades that you and Peter have done over these last few weeks.
Sure. You all have heard us talk before about, one of the key tenets of the portfolio goals are that we want stock selection to help us perform well in up markets, but we strive to protect money better in down markets. And I think that is really the illustration of what we're trying to achieve with the buckets of growth. So we did do some analysis on our 2019 performance and try to figure out how we can improve. What can we learn from 2019? And as we looked at down capture in 2019, there frankly weren't that many data points because the market was straight up. But some of the learnings of that were that the weaker performing areas in the down markets during that year were financials and mid-cap tech. And I think it was that we had been thinking about our financials exposure anyway, but it was that understanding of BlackRock as really a levered play on markets that was one of the catalysts that helped us sell BlackRock at the tail end of 2019, early 2020. So we exited that position, I think, in a timely basis. And that same learning in mid-cap tech, just understanding that the mid-cap tech names had certainly held up well in a bull market, but part of that is because they have a higher beta and higher volatility. And so in a down market, we need to be cognizant of that. And it was that thought process that led us to trim some of our Qualcomm before the downdraft started, and also trim some Palo Alto. I think one of the interesting things about the performance of the portfolio and how it's acted over the last couple of weeks has really been helpful for us in thinking through where we want to go and what moves we want to do. I think I would almost put the downdraft into two different groups. Since 2019, since February 19th, the portfolio, this was as of yesterday, is down 19.25% versus the RLG down 18.5%. So 75 basis points worse. And you might ask, well, why? You just talked about protecting money better. And I would say that what we saw in the first part of the downdraft was that traditional defense did not outperform. McCormick and Oracle and Comcast, they kind of held up in line with the market, but they really should have been more defensive. Part of that was probably passive, which of course has grown as a percent of the average trading volume. But we've seen during this that passive has been even more than it has over the last couple of years. Last Friday, I saw a statistic that passive trading as of last Friday was 26% of the daily volume versus a typical 19%. So it's a bigger percentage. And when someone says, "Get me out of that ETF today," the ETF then goes and sells Johnson & Johnson just like you would something that's a higher beta stock. The second thing we saw in the first part of the downdraft was that defense and healthcare didn't really work, because at that point it looked quite likely that Bernie Sanders could potentially be the Democrat presidential candidate. Post-polling was quite strong during those weeks. And so, of course, that overhang of more broad healthcare reform was still a risk in the healthcare sector. That lack of defense in healthcare, if you will, has reversed course over the last week or so. But in the early part of the downdraft, it wasn't. And then lastly, those mid-cap tech names, which I talked about in terms of leading us to sell some Palo Alto and Qualcomm, but you did see that in the first part of the downdraft, those names did not hold up well, even though we had Palo Alto and VMware report fine results. A nervous market meant fine, but not perfect results still led to stocks that underperformed. What you've seen since I just kind of looked at the data points since March, and since March 9th, the portfolio is down 11.4%, and the Russell 1000 growth is down 12.8%, so 140 basis points better. And what you see in that time period, just to help give you a flavor for what I'm kind of seeing in the market, is that you are starting to see defense look a little bit better. You're also starting to see some names in the portfolio that are, I hate to say it, but beneficiaries of the disruption. Things like Costco and Akamai and Amazon are all benefiting right now. and that's helped. In addition, some of the early moves that we made in the portfolio, things since I would call it in February, things like trimming our exposure to energy second derivative names, trimming our exposure to interest rates. Those moves had led us to hold a little bit higher cash, and that has certainly helped in March. So right now cash is around 3%, and that's obviously been helping us. And then lastly, as I mentioned before, the healthcare has started to work and be more defensive. So those are all kind of contributing together to, I think, make the portfolio in the month of March act a little bit more in the way that I would expect it to act. So, just taking a step back and thinking about other moves that we've made in the portfolio, in addition to, trimming things that might have a more levered balance sheet, again, trimming things that might have interest rate exposure and trimming things that might have some exposure to the energy sector, has been just a general theme of upgrading, trying to upgrade the portfolio. One example that I'll call out is a shift from McCormick in consumer staples to Monster Beverage Company in consumer staples. And that was in the SMA portfolio. Within the backdrop of a weak macro, we think that Monster should still be able to achieve faster growth than McCormick. They have a rock solid balance sheet, no debt. In fact, on Friday they just announced a $500 million share buyback, and very fair valuation for a market leader in a good space, as recently evidenced by Pepsi's purchase of Rockstar. So that's one where we think Monster is a name that we're happy to hold for the next couple of years, and we think we're buying it at a good price. So we're trying to do more and more things like that, where we're swapping and kind of upgrading the portfolio. The other area that I would just to highlight is the healthcare. I mentioned healthcare is performing well of late, but I think there's probably still more work to be done in healthcare in terms of some upgrades to the portfolio and maybe adding even a little bit more exposure. Right now we're just a little bit underweight versus the Russell 1000 Growth Index in healthcare, and I wouldn't be surprised. We're certainly spending some time trying to find some names that have good exposure there.
That's super helpful color on kind of all the activity that we've seen over the last few weeks. So maybe last question for you is, we always say that we don't try to predict the future because nobody really knows anything, but what are you paying attention to over the next few weeks heading into earnings season, and then maybe to that kind of work that you're doing with the analysts? What's going to be your key focus once you get into earnings season here in a few weeks?
Well, look, I think that earnings season is going to be weak. I think first quarter results will be weak. I think second quarter results will be weak. I think third quarter results will probably still be weak. And part of that is because the shocks that we're seeing to the system right now are very broad. It's supply chain, which impacts technology and impacts industrials. And that's mostly the Asia ripple effect on supply chain. It's certainly going to be an issue for companies. It's demand. Consumers are distracted. Consumer confidence is weak, and people are focused on other things other than buying right now. It's the energy price war. Now that actually, if you had looked a decade ago into the impact of an energy price war on the U.S. economy, it actually would have been a stimulative impact. And now, because our energy industry has grown so much in the United States, it's still a headwind to us. It helps the consumer at the pump, of course, but it also employs a lot of people. And so the energy price war is a net negative. And so there's just a broad range of impacts that we're going to hear about from companies. And so when I keep telling the analysts, let's focus on what's going to work on the other side, it's because we know that the results aren't going to look good. But if we have a long-term hat on, we can buy good businesses and good business models at good prices for that long-term appreciation potential. So I think we'll continue to be doing more, and I wouldn't be surprised if our trading activity continues to be quite healthy. Healthy, when I say healthy, I mean healthy for us. Our turnover is always probably on the lower end versus our peer group. On the macro level, I would say our focus is really on two things. Economically speaking, we know a lot of monetary stimulus has already been announced, but we're looking for fiscal stimulus, and what comes out of Washington and how quickly those moves can help the consumer are going to be important to understand. So fiscal stimulus, I think, is going to be really important to helping us move through this and start thinking about just what are the good businesses. And then, of course, obviously the second thing is we need to see a slowdown in the growth of the virus. Data points supporting the thesis that we're flattening the slope of virus contraction means that businesses and consumers can pivot to focusing on the recovery. And so that, of course, is really important.
Well, we made it through this call without hearing from Emery, Knox, Rhea, or Rain in the background. So
I was expecting that any minute.
Those are Margaret's two sons, and the latter two are my two daughters. But I just want to close with, as I said at the beginning, we have a lot of clients who have entrusted Margaret and Peter to be stewards for their large cap growth assets. But we know that the people listening, you have a multiplier of that of clients who entrust you. So we know these are extremely volatile times. Being able to provide perspective, I would say, is one of the things that we hope we can do much better than our peer group. We're going to try to do this more regularly through this cycle. Please reach out to your ClearBridge representative or our parent company like Mason, their representative, to give you additional context. We wish you Godspeed. Good luck. I'm going to close with a disclosure around our comments for today, which is that, hold on. Give me 1 second here. That these comments are our views as of March 17th of 2020. And, sorry, oh no, I'm screwing up on this part. Sorry. Please note the following: that past performance is no guarantee of future results. The opinions and views expressed in today's call are of the individual speakers as of March 17, 2020, and may differ from other managers or the firm as a whole, and are not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments nor its information providers are responsible for any damages or losses arising from any use of this information. Thank you.